Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and how you invest. I'm Stacy Smith, and thank you for joining us. We have a lot to talk about today, and some of the topics we're going to get into include whether this downtrend in the market is going to continue. Also, the Fed meets this week. We'll discuss what the Fed might do and how that might impact the markets and your investing. Also, your relationship with your financial advisor. How should that be? And finally, we'll talk about politics and how that might have an impact on how you invest. It's all coming up. With me to talk about the economy and investing is my panel of experts and advisors, and they are Carrie Coghill of Coghill Investment Strategies, Frank Rossetti of HF Management Company, Kim Forrest of Boca Capital Partners, and Michael Godwin of Fergasso Advisors. Thanks again for joining me for The Bull, the Bear, and You. You guys have been good the last couple of weeks?
Yes.
Yeah.
Vacation here and there or anything? That's good. Now, the last time we met, I asked whether the big moves in the S&P 500 and the NASDAQ could be sustained. And most of you had your doubts. And for at least the last 2 weeks, you've been correct. The NASDAQ has lost more than 1,000 points, but on a percentage basis, that's a little more than 5.5%. That's still a sizable downturn in just 2.5 weeks. Now, for the S&P 500, it surged ahead, then lost nearly 5%. And at the open on Monday, it was sitting at about the same spot it was when we recorded our last program. Now, the Fed does meet this week, and I do want to get your thoughts about what you think the Fed might be doing, but let's focus on the markets for right now. So my question is, will this 2-week downward trend continue, or will we see the bull market continue? Michael, that question goes to you first.
Thanks, Stacy. You know I love talking about market movements day by day instead of.
I know you do.
Well, I'd like to at least point out that it depends on which market you're looking at. We as in most investors, I think, always focus on the large cap names, the S&P 500, and I guess the NASDAQ, because that's been the most dominant index over the past, really the decade, because it's so heavily into tech and growth stocks. But and to your point, yeah, it's been pretty stagnant over the past month. And I'll get back to my outlook real quick. But if you look at a different indice, like the small cap value index, that's up 12% over the past month alone, while the NASDAQ and the S&P are flat or maybe even down at that point. So there's been a huge reversal in performance over the past month compared to what we've seen over the first 6 months of the year. So it's really depends on what you're looking at here. I think a lot of investors are so they don't see the forest in the trees sometimes, and when they look at the markets, they're only focusing on one segment of the market when in reality, there is a whole host of different areas and different factors and different indices and different market caps that you can invest in, depending on where you think we are in the economic cycle. Now, do I think the market can resume its bull trend? I do. I think there's going to be a lot of volatility in the near term. I don't want to talk about the election right now, but that's going to play a part in it. Kim, I'm sure, will love to talk about the earnings season that's going to be coming up. That's going to be a huge earnings season because we are starting to see, I think, some headwinds in regards to the unemployment numbers picking up. We're starting to see new home sales decline a little bit too, which, there are some headwinds there, but there are some good news indicators out there. Credit spreads are very, very tight, which generally signals kind of like an all clear-ish sign on the bond market side of things. So a lot remains to be seen over the next couple of months.
This week is going to be pretty interesting. We've got the Fed meeting, and they'll give us what their indescribable indication of what they're going to do in the future. And then we've got a lot of earnings coming out. And of course, we all know that the inflation numbers seem to be settling down a little more. And if that continues, and this slowdown that Mike talked about, I expect to hear them talk about September a little more clearly than they have.
All right, let me throw this out. The Fed does meet this week. And in a moment, we're going to talk about what you guys think the Fed might be doing and what the results of that might be. But I will throw this out. Michael, you indicated that there are some big earnings reports coming out. I think Apple and Amazon, Microsoft, all are going to be reporting this week. So will that have a bigger impact on where things go rather than with the Fed meeting? Anybody?
I think so. I think the Fed, we'll get to this in the next, we're
Yep.
teasing this in
Right.
the next segment, but the Fed's going to do what the Fed's going to do. And what investors are looking at right now are what are individual companies doing and what are the sectors they're operating in? What do they look like? And that's what we get out of earnings season, is not just what happened in the past, but the pipeline for the future. This is super important. I can't overstate it enough. And I think that we're seeing there's winners and losers right now. Whole sectors are not winning like they have in other earnings season, where you go, the banks are back, or healthcare, or whatever. But we are seeing some companies outperforming their peers. And that is a lovely thing for investors in individual stocks, or even not in individual stocks, I guess. It depends on who you're, what ETF or mutual fund that you've bought. But it is so important. And this is what we're going to see this week, is the more of the tech earnings that to date have driven the market, which even though I'm an ex-tech person, they're a little ahead. We'll just put it that way. And some are more than a little ahead. But this is what we're going to learn this week. And I think the Fed doesn't really matter to this earnings season at this point.
Yeah, so it's really interesting because the volatility that we have been experiencing the last several weeks has been showing a clear shift from those techie names, those growth-oriented names, into more value-oriented names. And also we've seen a run up in small cap. So the real question is, what does that mean? And when you follow the data, and Michael had mentioned this, the unemployment rate, which stands right now at 4.1%. The last time we had an unemployment rate above 4 was in 2021. So clearly the employment market is slowing down. We have said, repetitively, the message of be careful what you wish for. Everyone's been so focused on rates going down, without really understanding the reality of why rates would go down. Rates will come down when there is an idea that the economy is starting to struggle. So it's been fascinating to watch over the last couple of weeks, because this narrative of, everything's going to be great when the Fed starts to reduce rates. Well, as we've gotten economic data out the last few weeks to support the idea that the Fed's going to lower rates, the market hasn't liked it, because it means that the economy is slowing.
It's very interesting to see that in conjunction with small cap value outperforming. Typically, you see that area of the market really outperforming when we're coming out of a recession, when we get the all clear sign. So I think there's a really interesting dichotomy between the type of the market that's outperforming right now versus where we are from an economic standpoint.
Yeah, I've had people say to me that as they've seen this Nasdaq decline over the last couple of weeks, their portfolios have not been that affected adversely. I mean, I guess this goes back to what you guys have always preaching about diversification. Is that why their portfolios are still holding up steady?
I believe that's totally accurate. I think that diversification lets you participate in the fact that small cap and value are now going up, and what has been driving the market when your portfolio is underperforming because you didn't have it all in those 7 stocks. That diversification is starting to level out those peaks and valleys around the indexes versus your portfolio, and the wisdom of diversification.
All right, good. Kerry, you're back again. Thank you for getting out and coming back in. We don't know what happened there, but maybe that's an indication why the Nasdaq is going down. I don't know.
Well, the last thing I did here was that Michael was going to wrap up my comments, so I have confidence that he knew what direction I was heading.
I think he did. We have to take a break. We'll be right back. Welcome back to the Bull, the Bear, and You as we take a look at the economy and investing. As we mentioned, the Fed meets this week and will be announcing its decision on interest rates on Wednesday. Most analysts do not expect rate cuts this week. But Kim, you were quoted in the Wall Street Journal this past week stating that and I'm going to use your quote, we are on a path for a rate cut, most likely in September, end quote. Now, why do you say that?
Right. Well, a couple of reasons. I'm a big Fed watcher, and I think anybody who buys and sells securities for anybody is a big Fed watcher. You know, everybody on this program is a big Fed watcher. We'll put it that way. But more, I look at what the Fed has said over the past, I don't know, 7, 8 years, whenever the Powell Fed started. He said he's going to be data driven, and gosh darn it, he is. He's data driven. So, and he's very focused on his mandate, which is full employment and stable prices. Well, we used to have kind of both of those, and then we didn't. And he's trying to get us back to that. And he said he will cut when, you know, the data warrants it. So he has been very, very good about holding to higher for longer. That's his motto. And until maybe 3 weeks ago, where he goes, hey, maybe we could see a cut. And that's because a couple of things have been happening. The Fed's favorite indicator of inflation, the PCE, continues to come down. Whether or not normal people actually feel that is irrelevant. It's the Fed's data that is driving this. And then the other thing that he's concerned about, and Carrie touched on this in the last segment, is that unemployment seems to be trending up. And I think he's really trying to walk that line to say, look, prices are coming down, inflation's going down, and unemployment is going up. This is the time for a cut. And I believe September is going to have that data. It could happen on Wednesday, but it's unlikely because I think they really want that extra month of data. We'll get jobs data this week. We'll get jobs data sometime in the beginning of September, and then the Fed's going to meet. So that's one more PCE and 2 more jobs numbers. And I think that is why, you know, the tone of the Fed has shifted, and he'll get more data that will probably support the shift to cut. There you go. I liked my quote better. It was shorter.
That being said, Kim, the GDP report for the second quarter was up 2.8%, which
Yep.
to me was surprising. I was expecting it to be more in line with the first quarter, and it was much better than I thought it would be. And that being said, it'll be interesting to see how the third quarter rolls out, which we'll learn that in about November.
Right. Well, I have to jump in here and say, for those of you who are mathematical modeling minded, as I am, there's some quirks that go on in the first quarter that has probably since 2016 has suppressed the first quarter GDP. I'm not sure what it is, but there is something. So that's why I kind of tossed that first quarter out and always kind of averaged the last 4 as opposed to looking at Q1, but that's just me.
It's probably a good idea not to look at any one report of anything. Look at an average of the last few, I would bet, simply because things happen weather events,
Right.
boats hitting bridges that mess things up. I mean, these lightning strikes that nobody can predict, but they do affect things.
Carrie, in the past, you've kind of indicated you're a little tired of the whole Fed watch thing. Am I incorrect on summarizing it like that?
No, I think that we just obsess about it when there are other things that are more valuable, like the data, and that's why I appreciate these conversations about like what's GDP doing, what's unemployment doing, because the Fed has been clear, as Kim pointed out, they're data dependent. So to try to figure out what they're going to do, it's common sense to me. Well, then look at the data, because that ultimately is what matters. I do think that there is a pretty good chance that we see a cut in September. I think there are a lot of reasons for that even go beyond, the numbers here. When you look at the global economy, you look at what's happened with the ECB, that the ECB has lowered, and they may be a one and done type of cut. I think that we could be a one and done type of cut. As you know, I have felt that the dialogue about rates going down 6, 7 times is just insane, because no one knows. You have to watch the data. I actually think that the markets and the economy, we never give it credit, right? We always are assuming that something's wrong when actually things are going pretty well. I mean, the fact that this economy has been able to sustain higher interest rates for as long as it has, and we're just now maybe starting to see some cracks, I think that's a really good thing. And, do we need a rate cut? I'm not convinced of that yet, but I do think that we'll probably see a move in September.
A rate cut, though, would really help the housing industry, wouldn't it, Michael?
I don't know. I mean, 25 basis points is 25 basis points. I don't know how much it will help the industry all that much. I mean, Carrie, she brings up a heck of a lot of good points there that I can't add too much more onto it. I mean, I know she doesn't like watching the Fed. None of us here are traders. I mean, the Fed's
Hmm.
movement in September, they'll cut. It might impact the markets very temporarily, but what Kim pointed out before, I did a presentation for some of our clients this past week. If you the best indicator for the stock market, certainly over somewhat of an extended period of time, is earnings. I mean, there is a direct correlation between earnings
Yep.
and the price of the S&P 500 or whatever index you want to watch for. So, to Carrie's point, we're data dependent. We look at the data, and I love looking at the earnings of these companies. But the one big thing I got wrong over the past 2 years, Carrie just pointed out, was I didn't think the economy could withstand the pace of rate hikes that the Fed had. I mean, I don't think I'm in the minority there. I think a lot of people thought we'd have a recession by now, but Carrie's right. Things aren't nearly as bad as a lot of pundits make them out to be. The economy is still pretty strong. Will we get a hiccup? Absolutely. Will we get a recession? 100%. I think any market pullback we get over the next, hopefully the near term, is just going to be a healthy consolidation of the market, and the economy still does look pretty strong. In my view.
I'm going to write this down and we'll talk about possible pullback and how deep that might go if you're thinking about that for our next session, but not today, if that's all right.
Yeah.
We need to take a break. We'll be back, unless you had something you wanted to say, Kim.
I was just going to throw out a contrarian little thing.
Sure.
I think we're in a slowdown. I think the consumer has slowed down. I'm somebody that thinks that we won't go into a recession unless there's a crisis, because we have these rolling slowdowns. And I really feel strongly. I went shopping over the weekend and found parking spaces in places that I didn't expect. We went away for a day trip, and there weren't families, like the number of families that I've seen at this place out and about. I think that I even talked to of course I did, the sales clerks, whether or not this was a last year, this year difference. And they're like, oh yeah, actually the last two, they've seen slowdowns. So we are, oh, and McDonald's today, they announced they really missed expectations. And a lot of it is people just not spending on on things that aren't necessities. So I just want to throw that out. Maybe we talk about that next week. But I don't think that this collapses the economy, though, even though the consumer's 70% of the economy in the U.S.
All right. Well, after the Fed has its meeting this week and we get the other earnings reports, let's delve into that a little bit next week. We need to take a break. We'll be back in just a moment. Welcome back to The Bull, the Bear, and You. I was at a party over the weekend, and someone made mention that after they retired, they had more time to delve into their portfolio. And it was to the point where they were fixated about what was happening. So, Carrie, now part of your job is to offer advice and guidance and suggestions. And no doubt you want feedback from your clients at some point. But what should that relationship be? Because the person I talked to said that finally their financial advisor said, please find something else to do. So what's your take? What should that relationship be?
Yeah, I get that. I understand. So the relationship between an advisor and a client is extremely important, and we take that obviously very seriously. I appreciate dialogue. And the one thing that as an advisor we have to know and remember is that we are here to provide our expertise. And I'll be honest with you, sometimes clients don't understand or might not agree, but that doesn't mean as a professional that I'm going to change my opinion. If you go to a doctor and the doctor says you need amoxicillin and you say, I don't agree with you, I think I don't need anything, it's kind of the same thing. But that relationship, in order to understand how to invest a client's money, you need to understand their psychology, the psychology behind it, and understand the things that make them nervous, the things that they obsess about, so that a portfolio can be created that will put them at ease. And this is where the personalization comes in. You know, it's hard as an advisor to, you can't manage a different portfolio for everyone, but you need to have different tools in the toolbox. And if a client isn't comfortable with the strategy, then as an advisor, I need to find another way. But at our firm, and I think that I don't know how everyone else here works, we have discretion. So if we're going to engage with a client, they're going to know that we will make the decisions without engaging them for a yes or no answer. So they have to be comfortable with that, which means they have to be comfortable with our philosophy about how we're managing money, and we have to be comfortable with their risk tolerance and really work to create a strategy so that they can entrust us. It's a very important. It is their money. We can never lose sight of that.
The regulators have thrown out a set of rules that lead us to believe that we're supposed to not do what our clients want because it's not in their best interest. They fail to understand, as Carrie just said, it's their money, not ours. And if they want to do something, whether it's in their best interest or not, it's very difficult, in my opinion, for us to not do what they'd like and note the fact that we weren't in favor of it.
A little different opinion on how that works from Carrie's. That's interesting. Kim, your thoughts?
Well, I have a handful of direct clients, and most of my clients are indirect. They are another advisor's clients. But that being said, I have been known to be Dr. Google before I go to the doctor's office. So I understand the client's frame of mind when they're, I'm going to go in with the answer to what is wrong with me. And a lot of people do the same thing with respect to, I've got the answer to what is wrong with my portfolio. And all of us need to be heard, but we all have to either decide to trust the doctor, to trust the professional, let's put it that way, and to really dig in. That's lovely that this person thinks that they can have the time and energy and maybe ability to do what, we've all spent our entire professional lives learning, that they could pick it up in a few months, but perhaps that's not true. But I think Carrie's right. And I'll even say, I think Frank's right too. Ultimately, it's the end, it's their money. And we have to figure it out with them. So I want to hear what Michael has to say about this.
Yeah, I think all great points. And Carrie's right in terms of we all have clients that look at their portfolio not just once a day, Stacy. I mean, multiple times a day. And if they're calling because the market's down and they lost some money, Carrie's right. Maybe you're not in the right portfolio for what you want to accomplish, right? There's one, you want to set out to hit your financial goals, but there's also the element of you need to be able to sleep at night, or you need to be able to stay awake and not look at your portfolio 15 times a day. So it's really a fine balance of making sure that you can hit both of those objectives within the type of model portfolio they have. The other thing that I like to do, Stacy, is I try hard to put myself in their shoes. I mean, we've spent the vast majority of our lives working and getting a paycheck every 2 weeks. But once you stop receiving a paycheck every 2 weeks, your mindset has to change. And I have never lived that yet. So I'd really try my best to see, boy, if I'm not getting that income every 2 weeks, how is that really going to impact my mental capacity to really withstand some of these market movements in my portfolio overall?
I think that's exactly where this person was coming from, as a matter of fact, is they had more time on their hands and they were looking at it. It wasn't that they thought they could do better than their financial advisor. They just had questions. This is going up, this is going down. You get a little nervous when, if you're working, you're not looking at that portfolio all the time. And it's a learning process, I think, when people first retire.
And
And
that
can
leaves the avenue open to make mistakes to your portfolio, make changes when you shouldn't be making the changes. Something's going down, oh, I got to get out and sell. Something's going up, okay, take those losses and run. I mean, that's a classic example of mistakes that you shouldn't make as an investor.
Yeah, it's that relationship is really important. And the dialogue with clients, like I said earlier, they need to be able to sleep at night, and we need to be able to find a way to help them along and answer their questions. And, I've learned a lot from clients. Sometimes they bring a perspective that I didn't see. So I really respect that. I've only told one client ever to go find a hobby, and that was my husband. So, last week, the way that I found out about the CrowdStrike snafu was because the very first thing my husband does in the morning is look at his account. And he's like, I can't get into my account. I'm like, yeah, go to work.
Exactly. All right, we need to take a break. We'll be back in just a moment. Welcome back to the Bull, the Bear, and you. Frank, let's talk politics for a few minutes. We don't have a lot of time. We may have to go back into this one
I'm
as
happy
we
to
get.
hear we don't have a lot of time.
Okay. We've talked about everything else here, but so and I don't want to get into, who's right, who's wrong, or which party's right or which party's wrong, right or wrong, but should politics play a part in how you invest? Michael alluded to that could be having an impact coming up in the fall, maybe.
The politics will create emotional moves in the market. Remember, the market is an emotional thing on the short term, which is why we don't trade. You cannot predict the emotions. All right. About 100 years ago, a journalist named Ernest Benn penned these words: politics is the art of looking for trouble, finding it everywhere, misdiagnosing it, and applying the wrong remedies. Winston Churchill repeated that, and he gets credit for it, but it was a journalist in England that wrote that. And 120 or so years later, those words are as true as they've ever been. That being said, absolutely not. If you're a long-term investor, ignore politics.
All right. You guys agree?
I'm going to push back. If you have some sectors, like if you're overweight things that need government intervention, like let's just say renewable energy, you're going to have to watch politics to see who is going to win and whether or not subsidies go on. But by and large, I agree with Frank.
Yeah, I think that the short-term volatility of the market does not depend on the election. However, I'll push back a little harder because there are significant implications to a person's wealth management strategy given what goes on in Washington, particularly as it relates to taxes, whether it's income taxes, whether it's estate taxes. The tax cuts that we saw when Trump was in office are going to sunset at the end of next year, which means they're going to revert back to where they were. That has significant implications to a person's tax planning and estate planning. So we're paying very close attention to how this will play out. And it's not just the presidential election, it's also the congressional elections too, to see what types of policies might get passed through. Now, like I said, in the short term, are we going to make decisions leading up to November? No, because those types of things have to get worked out and bills need to be written and passed and everything else. So we have a little bit of runway, but we are paying very close attention to that.
Michael, can you wrap it up for us?
I can. I have nothing further to add. I think they hit the nail on the head, all of them. That's perfect.
Spoken like a non-politician because you didn't speak. All right, I want to thank all of you once again for joining us for the Bull, the Bear, and You. We will continue to look at investing in the economy and in our future editions. But for right now, thanks for joining us, and we'll see you again the next time.